My name is Bill Ray. I'm with Alumni Financial Services. I've been in the business in the finance world for well over 20 years. Your question is, how do surety bonds work? That's a great question. First of all, let me start this off by telling you we're not giving stock or bond purchasing advice. You need to talk with a licensed professional if you're actually going to invest in these things. But let's understand what a surety bond is. First of all, a surety bond has a minimum of 3 people involved. One is the principal, the other is the obligee, and the other is the surety. Probably the best example and the easiest to understand this is to think about the American court system. We commonly call them bail bondsmen. You get in trouble, you're in front of a judge, and he says you have to post a bond. Let's say, for example, your bond is $5,000. You call a bail bondsman and say, help, get me out. The bail bondsman puts up money, generally about 10%. And he says to the court, he'll make sure that you show up to answer your day in court. Now, if you take off, the bail bondsman is liable for that $5,000 bond, which is why the bail bondsman, if you skip, searches you down, breaks your leg, and drags you back to court. That's a very simple idea of what a surety bond is, but I hope you get the idea. It requires 3 parties. One makes a promise to make sure someone else fulfills the obligation, and the third party waits till it all comes together, if you will. But as in everything in finance, you really need to understand whatever agreement or contracts you're getting involved in. You need to understand what's required of you, when and how you get your money back, and how or what reasonable returns you should expect on your money. The bail bondsman makes his, and you should yours. But always seek competent advice. My name is Bill Ray. I'm with Alumni Financial Services, and we're always here to help you build wealth.